Those required minimum distributions are a way for the government to collect more revenue, for them to tax you, right? Because remember, all that money that's been sitting in a 401k or IRA is money or income, really, that's been deferred by you and has not yet been taxed by the IRS. Well, if you're the government, you want to get a slice of that action sooner rather than later, and you've been allowing employees across the country to defer the recognition of income. In other words, delay paying you, the government. And so required minimum distributions is just one way among a few others that they force this money out so that they can tax it. I work with a number of families all across the country who, because of required minimum distributions, in connection with them being disciplined and saving in their 401ks throughout their careers, are now recognizing more in income and consequently income tax than they ever did while they were working. Yeah, that's the negative power of required minimum distributions. All pre-tax retirement accounts, IRAs, 403bs, thrift savings plans, these retirement accounts have RMDs, required minimum distributions, built into them. And if you've been disciplined and saved, and the majority of the money you have for retirements and pre-tax accounts, a day of reckoning will come for you. Thankfully, based on some recent legislation, these required minimum distributions do not apply to Roth accounts. Roth IRAs, Roth 401ks, they do not have required minimum distributions like their counterparts, the traditional side of retirement accounts do. So what can you do to combat RMDs, and when do they start? And how much are we talking about here? RMDs right now, if you turn 73 this year, they kick on. And you have to start taking distributions. Now in that first year, you have till April to get the distribution out without facing a penalty on top of the income tax liability associated with that distribution. But every year following, you're 74, 75, 76, you have to take that distribution out by year end. That distribution, like I mentioned before, is all generating taxable income for you in the year that you take it out. It's based on a table through your age. So the older you get, the greater the percentage is that you have to take out as a required minimum distribution. So when you start when you're 73, the percentage is relatively small. It's hanging around percent. As you get older, it goes to 4%, 5%, progressively higher as you age. It's based on your previous year's ending account balance as of December 31st. The way they look at it is they look at what was your account balance in your IRA and 401k and all your other pre-tax retirement accounts. They take that number, divide it on a factor based on your age, and that's what you got to spit out. So if you've got a bunch of old IRAs and 401ks all over the place, you may forget that required minimum distribution exists. And I will tell you, this is a common pitfall that a lot of people make, is they forget they have these old retirement accounts. They may just have a couple of $1,000 or whatever, 10 or 20,000, whatever it is, but that can add up over time. If you've got more than that, hey, that's even more reason to consider consolidating so that it's all in one place and you don't have to stress out too much that you're missing something and you're in compliance with the tax code. There's not very many fears or anxieties that are worse than breaking the tax law and being afraid of an IRS agent coming knocking on your door. Now, they normally don't knock on your door unless you're in some gross violation, but getting a letter from the IRS, it causes quite a bit of anxiety for most people. And I don't want that to be you if you forgot about an old required minimum distribution.